प्रेजेंटेड बाय ईबिक्स कैश, हर खुशी के लिए काफी है।
We have a very special guest on our show today, who's not just a very successful investor over the last few decades, but also one of the most respected investment bankers in the country. He's helped so many of today's large companies to market, has advised them over a period of time, and it's his ringside view that we would want to draw on today. Manish Chokhani, Director of Inam Holdings, is with us today. Manish, it's always great to speak to you, but it's such an interesting juncture in the market. With so many IPOs coming in, this multi-billion-dollar Paytms and Nykas, it takes me back to that previous big tech IPO boom, which you were part of, the Infosys IPO, etc. But how do you relate that to what is happening today in the market? Are there parallels that you see, or do you see any kind of mispricing or froth in today's IPO boom that we are witnessing around us?
Wow. So first, Sudhir, let me say welcome back. It's been a while since we saw you. So to you and Aabha, very, very happy Diwali, and to all viewers as well. As far as I'm concerned, I left the investment banking world, as you know, 7 years ago. And I've been happily leading life as an investor, helping companies to build out and scale and all as well. So to answer your question, yes, that in terms of market cycles, it's not unusual that you will see, for example, in what we call phase zero, where the economy and the market's flat on its back. You get fiscal stimulus and you get monetary stimulus to try and get the patient moving again, which is what we saw really coming from the West. And it's really that which kickstarted, where you saw metals and IT and all these stocks just flying. And of course, with that wall of money which came in, and seeing that we are the next big market after US and China that the world can invest in, and you'll have this billion consumers coming eventually to becoming consumers. A lot of the private equity money in the world has flown here as well. So if you put these two things together, it's not unusual to see that some of these companies which were funded a few years ago would come to market. And in the market, which itself is hungry for new innovative companies and disruptive companies, it's a marketplace. Now, you may have a view on valuation, I may have a view on valuation, but what I learned in my banking days was I'm no one to judge. I may be a value guy or a growth at any price guy, but if there is appetite for something, the market will clear it because it's really an auction. And that's what seems to be happening, that the demand when money is so easily available tends to go for things which are very scarce and rare. When money is tight, you look for productivity and assets which are generating cash right now. So it's not unusual what is going on. And in that sense, it's not unlike previous booms of 2008 when we were funding infrastructure, real estate, which were building out for the next 5 or 10 years. It's not like the 92, 93 Infosys era when these were already cash generative companies, but they were small companies. Whereas these have already been made into these large companies with the backing of the likes of SoftBank and others, which have kind of chosen the two winners, which will dominate the marketplace in whatever field they're playing. Now, how they execute, whether they execute, how the unit economics play out, that's best studied bottom up. It's not a one size fit all. And the Nykaa model is very, very, very different from the Paytm model. And therefore, I wouldn't like to generalize on anyone in particular here. I hope that answers.
Of course it does. But since you spoke about cycles, Manish, there seems to be such a lot of discomfort that we hear from a lot of professional investors today about where the market has reached. There are parallels of this market trading at 24 PE with what happened in 2001, with 2008. Do you get the sense that we are flirting with some kind of a peak in terms of valuations out here?
So great question. And it's something which we all, scratch our heads about, because typically our markets would tend to peak out at a 20 multiple. But remember, that used to be in an era when interest rates would bottom out at 5%. Now, in a world where interest rates, 5% in Indian context and maybe 3% in a global context. But in a world where the central banks are playing with the force of gravity, if you take rates low, the reciprocal of rates is a higher multiple. And I think everyone and every investor in the world believes that the central banks have boxed themselves into a corner and they can't afford to put rates up too much, and they have to really hurt the saver with these repressive policies, because there's no way this debt can be repaid. And the only way, therefore, is to transfer money from the saver to people who are taking risk. And therefore, these kind of valuations, at least for the foreseeable future, don't look like they're going to change. And I've been every possible media I could go on, I keep talking about how foolish India is being in amassing these reserves, which they are printing every week. And in theory, we should have allowed rupee to appreciate, allowed us to build scale, kickstart the consumption cycle, manufacturing cycle. But that's another debate altogether. But to answer your point, at the beginning of a cycle, money and fiscal stimulus comes in. You typically then get regulatory changes like we're seeing in India with privatization and a lot of the reform which is happening. You typically see a catalyst in some important commodity which takes off. And we've seen the whole commodity complex fly. So it's very much in that sense reminiscent of 2003 to 2007 cycle. And as the boom spreads, the high multiples adjust downwards because earning growth accelerates. And we've had this last decade where really earnings did nothing. And all we did was clean up our banking system and deleverage balance sheets. So you're arriving into this cycle with corporate India. If you take the Tatas, you take Ambani's, you take Bharti, you take Jindal, you take Vedanta, Birla, balance sheets are in great shape. Bank balance sheets are in great shape. The credit cycle is starting. So you will see an acceleration in earnings. So multiples should not logically stay that high for so long. But as earnings come through, you should hopefully see lower multiples. And the market will discern, because from time to time, everyone's getting the same information. So you're getting corrections which are very steep and sharp in between. So what earlier would take, a month to play out is happening literally midweek. And it's not all happening on one day. So one sector or one stock will correct. You may get a 10, 15%, window in that stock or in that sector. And then you could go back in over there. But it's in that sense a rotating bull market, which is still unfolding in my view. We haven't yet got to a stage where we suspend all credulity and say this time is different, like it happened in the last cycle when we said BRICS is very different and we'll take over the world. I haven't seen reports yet come out of that nature saying this time is different and India will become the next US or the next China and so on. So I'm hopeful about earnings actually still leading us for the next 12 to 18 months. Then we see.
I see your point, Manish. But the only question which I was trying to get at is, in this study of cycles that you alluded to, it would often play out in a way that over a period of, say, 3 years, 4 years, 5 years, the valuation would move up the spectrum and reach that 20 plus kind of a level. But this time it seems to have moved very quickly. I mean, if you take the starting point as the middle of last year, after where this cycle actually took off, within a year or 15 months of that, we've suddenly come up to a 23, 24 PE multiple. Are you sanguine that earnings will catch up to that extent, that valuations will temper next year? Or have we actually priced in too much, too quickly this time compared to previous bull runs?
So Udayan, again, as usual, your questions bang on. That 2003, 2002 cycle started with very low multiples. And we were all taken by surprise at how long the earnings cycle took off. And we had inflation-free growth for many years, and therefore the rates could remain low. This time, you're right to point out that we are starting with high valuations and rates which can't theoretically remain that low forever, at least in the Indian context. Having said that, the market's actually not been crazy, because if you look at last year, the FMCGs and the consumer discretionary, the durables and autos, they've done miserably. The stocks are probably 10% up when the index is 50, mid cap is 75, and so on. And what's led this whole jump, in my view, last year was the boom which came from overseas. So you got IT sector, which has gone from low teens multiples to maybe north of 30. And then metals, where the earnings have just gone completely through the roof. And when you put these earnings together, because together metals, banking and IT will comprise probably 60% of index weight. So you're seeing that, plus the consolidation which has happened in India, where we move from unorganized to organized sector. So 5 sectors are now probably 65 to 75% of corporate India profits. And in each sector, 3 companies are 80% of the profit. So 15 or 20 companies are basically half of India's profits. And as I said in the beginning, you take the Reliances, the Tatas, the Birlas, the Vedantas, the Bharatis, the profit cycle has exploded for them. And the numbers which are coming are not 10, 15% growth, but 50, 70, 80. So I think you will see dramatic change in earning trajectory. And banking, remember, is coming out of deep slumber of 5, 7 years. So again, it's not the Kotak or the HDFC Bank which performed last year. You're seeing the comeback big way of ICICI, Axis, and SBI in a very, very big way. So the market's changing. I mean, there is froth in different parts of it, but I can't say the entire market's going crazy. And it's not in some very large cap or a very large area of the market where you can point and say this is an obvious short.
Manish, I just want to also get a sense from you on the kind of trend we are seeing with regards to millennials, Robinhood investors, a whole new generation of investors that are approaching this market. And given the context, that you've just set in response to that conversation with Udayan, what really should some of these investors be aware of? Is there a danger really of getting their fingers burnt given the trajectory that we're talking about?
Yeah, I mean, that always is the case. Well, first is we waited for 30, 35 years for the Indian retail investor to come to the market. Access to the market has become far easier. Knowledge of the market and information on the market and companies has become far better. So they are generally better informed youngsters who are in there. But when you see a momentum and a trending market like this, it's natural that your emotions take over. And we were young also 30 years ago, and all of us have made our share of mistakes. And it's the nature of capitalism that people will burn their fingers. Whatever I say or anyone else says or whatever they read will have to be self-experienced, that eventually you make money by buying something for less than what it's worth. It's not based on what someone else will pay for it tomorrow. It's based on what that business will earn. And it is a period of suspended kind of gravity force of interest rates right now, which is forcing this trend towards let's buy whatever is scarce, whatever sounds disruptive or whatever is sounding very new age. And you may tend to get carried away over there. So certainly, I mean, for an average investor, as people have said all over the world, you're better off being in a fund because you're not really a stock picker. If you don't know business, you don't know the language of business and so on. But that shouldn't keep you away from the market. And also it's a function of what your allocation is. So if traditionally Indians had 3-4% of their assets in the stock market, and they thought of it as someplace I make money for 3 months and then I go back, it's not that anymore. You have to build wealth by investing in a business and in equities. And that's what has held us all in good stead over the years. I'm sure a lot of people will, burn their hands, lose some money, but it's best that you lose it when you're 25 rather than when you're 55. So I wish them in a good way, I wish them bad luck. So they learn this early and eventually make significant money, which is there to be made in the, Indian capital markets.
Manish, let me get back to one area which you alluded to, which is the IT sector, which you've tracked for a very long time. I can understand a new kind of a business, a digital business IPOing, and therefore the market looking at the future and giving it a 100 P multiple or a 20 times sales or a 25 times sales. But how do you justify a situation where a mature business like IT services, the Infosys and TCSs of the world, which used to trade for the long time at 80, 20 kind of PE multiples, suddenly with the similar kind of cash flows and all the strengths which are well known, are now trading at 32, 33 times next year's earnings. How do you justify this kind of a 50% expansion in a PE multiple in a fairly mature and well-known sector?
So I'm not justifying the numbers. I'm just observing as a market participant what's happened here. And you're right that if 3 years ago you would have spoken to a cross section of people in the market, they would have said the IT services sector is now X growth, because now you'll have robotics and you'll have artificial intelligence, machine learning, and you don't need these level of coders anymore. And then you cut to 2020 when all of a sudden we can't operate without Zoom and every business has to digitize. And it's become like a Y2K boom where you had to achieve digitization overnight. And all these guys have sacked their workers last year. And the attrition rates are crazy over here. So there is a table of pricing which is going up, margin expansion is happening, volumes are coming rapidly, and you've got this earning surprise going through. And with it, you've got this lower cost of capital, which translates into a higher multiple. So it's been like the opposite of a perfect storm in a sense for the IT sector. And remember, a lot of people had exited also. So they're very, like I said, in every sector, it's getting more and more consolidated, right? So if in the past you said I could go to Philippines or Ireland or whichever other geography, you now know I have to do a lot more work with these vendors which are there and who can deliver quality and deliver it quickly. So that's the reasoning behind it. I'm not sure that these multiples will last forever, as indeed most multiples are in the world, trending upwards based on low interest rates. But it is what it is, and there are $100 billion plus market caps. So it's not that there's one person pushing the price up. It's a collective wisdom of the market which is making it happen. It's similar, right?
No denying that. We are out of time today, Manish. Always a pleasure talking to you, and thank you very much for taking time out from Aabha and I and the entire team. We wish you a very happy Diwali and hope to see you again soon.
Wish you all a very happy Diwali. Thank you.